Okay, so just to reiterate, what we're covering today is a cash flow question. It's question 2 of question 2 of case study 2 of Tatlita 106 2020 FAC4862. So this is basically probably a past question paper, past exam, or a past test. Okay, so one of the two. So in Tatlita 106, they generally give you past papers, and they so as a Tatlita just with past with questions to work through. So we're doing horoscopes, which is a cash flow question, an entire cash flow question. You can see it's 49 marks, but the cash flow part is 44 marks. Okay, there's another part for 6 marks. I'm not going to cover that. So we're going to read through this. The idea over here is to learn how to read a cash flow question and how to attempt a cash flow question and then actually answering a cash flow question. So that goes as follows. Horoscope Ltd is a company listed on the Johannesburg Stock Exchange with a current financial reporting period 30th June 2019. The following information from the consolidated trial balance of the Horoscope Group for the year ended 30th June 2019 is submitted to you. This may be assumed to be correct, except where otherwise indicated in the additional information provided in the question. So in the first paragraph, they're telling you the current financial year is 30th June 2019. In the second paragraph, they're telling you, they're giving you a consolidated trial balance. Okay, so when we're doing cash flows, we're always doing cash flows from a group perspective in CTA. So we're doing cash flows from a group perspective. So what they will give you a consolidated financial statements or consolidated trial balance. And you will use the consolidated information, whether it's a financial statements or a trial balance, to complete the consolidated statement of cash flows. So they're telling you that's what they're giving us, and that everything is correct unless otherwise indicated in the additional information. So here they're giving us a consolidated trial balance. Okay, so we have land, we have property, plant, and equipment. We have investments in equity instruments. We have investment in associate. We have goodwill. We have trade and other receivables, inventory, cash and cash equivalents, share capital, retained earnings, mark-to-market reserve, non-controlling interest, deferred tax, consideration payable, okay, long-term loan, debentures, short-term portion of long-term loan, trade and other payables, shareholders for dividends, and current tax payable. What you should note over there, they're giving us the consolidated trial balance, but every balance over there is a balance sheet account. It is either asset, liability, or equity. When we deal with cash flows, you always want to set up a T account for all the balance sheet accounts. So, so for all the balance sheet assets and liabilities, you don't have to do for every equity account, but in most cases, it's going to be better to do for equity account. Although the equity accounts, besides ordinary share capital, the other equity accounts, retained earnings, revaluation, mark-to-market reserve, non-controlling interest, will hardly have or won't have a cash flow implication. But why do we still set up a T account for it? Because remember, the whole purpose of setting up T accounts is to get the cash flow figure. So in this case, in the most equity balances does not have a cash flow implication. But why do we set it up? Because sometimes the movement within that balance is required in another T account where we need the cash flow figure. So that is why it is just best to set up a T account for every account over here. You have one of two approaches, either a T account approach or a table approach, okay, like a note disclosure approach. So it doesn't matter. I will do the T account, but I'll also show you how to do it from a note disclosure point of view, okay? So you can use that as you're working. So remember, for, the way we're gonna get the cash flow figure is to set up a T account for all of these balance sheet accounts, and we assume every transaction is on credit. So what goes into the T account is any income statement movement, and then the missing figure, the balancing figure, will be our cash flow figure. Okay. So that means they only gave us balance sheet, but so we have to set up a T account for all balance sheet accounts. But in order to reconstruct a T account. So remember, we set up a T account for a balance sheet account. But in order, and the whole purpose that we set up a T account is to reconstruct the T account. Reconstruct mean that we re-perform the T account. We put in everything that should go into the T account in order to get the cash flow figure. Now, to reconstruct a T account, we need the income statement numbers. So that means somewhere in the scenario, they must give us the income statement numbers. So here they're giving us additional information. My approach is I draw up a T account for every account. Okay, I'm not going to do that in this scenario. I'll do it as we go through the additional information. What you do, you open up a T account for every T account that you see over there. You put in the opening and you put in the closing balances. It's just a little bit difficult for me because of the fact that, well, I'll find a way to do it. Okay, so I'll actually do it. So what we will do, we'll open up a T account, or you set up in a note disclosure style, every balance, let me just say now, you set up a T account for every balance. Then, in order to fill in, to reconstruct the T account, you now start reading the additional information. And you start by point number 1 and you work yourself through. So in this case, point number 1 is investment in associates. So basically the first account we're going to reconstruct is investment in associates. Once you are done with the with the additional information, you then run through all of the T accounts and you see which one must still be balanced. And you just balance it. And I'll show you how to do that. Okay. So step number 1, you open up a T account for each of the balance sheet accounts. Step number 2, and this is where you start the reconstruction, is where you read through the additional information. After each additional information, you use the additional information to complete whichever account is being impacted. Once all the additional information is done, you do step number 3. Step number 3 is to go through all the T accounts and make sure all of them are balanced. If they are not balanced, you need to balance them so that you can see if there's a cash flow impact. And remember, while you do step 1, step 2, step 3, whenever you get a cash flow number, while you're doing step 1, step 2, and step 3, and almost likely only happen from step 2 onwards, you go slot in the cash flow figure in the cash flow statement. Because remember, even if your workings is 100% correct, if you do not have the number in the cash flow statement, you're not going to get the mark. So as you get a cash flow number, you need to go slot it in somewhere in the cash flow statement. So at least you know you have earning some marks. Okay, so let's read the additional information. So basically what we do is you first read the entire scenario. So you get a gauge of the scenario. Then when you start attempting the question, you apply step number 1, open up a T account for each account, opening balance, closing balance. Then step number 2, read the additional information. As you read additional information number 1, you complete, you make use of all the information. Then you move on to step number 2, additional information number 2, additional information number 3, and so forth. Once all the additional information you have covered, now you do step number 3. You look through each T account and you make sure that it's balanced. If it's not balanced, you balance it. And then you slot in whatever is left over. Remember, by the time you do step number 3, majority of the cash flow statement needs to be done, because as you're doing step number 2, you are filling in the cash flow numbers that you have calculated. And after step number 2, majority of the cash flow statement will be completed, but there will be certain accounts that is not yet balanced. So you go balance them to ensure that you have covered all the cash flow numbers. So just keep that in mind. So additional information number 1, investment in associates. On 1 May 2019, remember what's our financial year end? 30th June 2019. So our financial year, what is going through the cash flow statement is any cash flow that takes place, any cash flow that happens from 1 July 2018 to 30th June 2019. Our financial year is 30th June 2019. So the beginning is 1 July, the end is 30th June. 1 July 18, 30 June 19. Anything that falls with any cash flow that happens during that period needs to come through in the cash flow statement. On 1 May 2019, Horoscope Ltd acquired 40% interest in Libra Ltd for a cash consideration of 405,000 Rand. Basically, that you go plug in immediately. So when we do the cash flow statement, when we set it up, after we read all the additional information, you must know you want to see acquisition of subsidiary 405,000 Rand. There may be, so that is what you'll have to do. Okay. Horoscope Ltd exercise significant influence over the financial and operating policy decisions of Libra from that date. The equity of Libra consisted of share capital and retained earnings respectively. Any excess that may have resulted from this acquisition was included in other expenses. Okay, so remember, they could either be when you have when you acquire an associate, although you need to calculate whether there's goodwill or whether there is a bargain purchase gain. Remember, bargain purchase gain is included in other income, but they're telling you they've included in other expenses, so that is fine. A goodwill, we don't account for goodwill, but we just need to make sure that there's a goodwill or a bargain purchase. Generally, a bargain purchase is included in other income. Here they're telling you they've included it in other expenses, so that is totally okay. It's very important to note that because the bargain purchase is a non-cash flow number, so therefore it's going to impact our other expenses when we calculate the cash flow for other expenses. Okay, so what you must do, you must make a note for yourself on the side to determine a bargain purchase or goodwill. We expect it to be a bargain purchase because they told us they're including it in other expenses, which is the profit or loss. Bargain purchase is going to the income statement. So just take a note of that. So that happened on 1 May, okay? On 30th April 2019, there were indications of impairment in respect of Leo Ltd, an associate of Horoscope Ltd. On 30th April 2019, the value in use and fair value less cost of disposal of the investment in Leo amounted to 250 and 233 respectively. The carrying amount on this date of the investment in Leo amounted to 275. Any impairment loss was included in other expenses. Okay, we can already see there's an impairment loss, because remember, an impairment is the lower of carrying amount and recoverable amount. The recoverable amount is the higher of value in use and fair value less cost to sell. So you can see the higher is 250, yet the carrying amount is 275. So therefore the impairment loss would be the difference between 275 and 250, which is the 25,587 Rand. So that is an impairment loss. So you want to make note of that. So next to that, you want to say impairment loss of 25,000, whatever the difference is, and take note is included in other expenses. Very, very important. We're going to come there just now, because remember, other expenses is an income statement number. An income statement number is based on an accrual concept. So whether there's cash or no cash. So we need to strip out what is non-cash in order to get the cash number. So we already know there are two aspects that is non-cash flow that is included in other expenses, bargain purchase gain, most likely, and an impairment loss. Let me say Horoscope Ltd did not acquire or dispose of any other investments in associates during the current financial year. Okay, so we're going to need to have to deal with, we're going to have to reconstruct the T account. So we know there's an acquisition, we know there's an impairment, and we know there is a bargain purchase. So what does that mean? They're telling us that there was no Horoscope did not acquire or dispose of any other investment in associates during the current year. So that means the account needs to balance, because there's no other disposal, there's no other acquisition. If the account does not balance, then it's one of two things. Okay, it is either going to be share of associates profits, or it is going to be a dividends. So we'll have to figure out which one it is. If they don't tell us about the dividends, then it can only be share of associates profits. So you must know all the line items that can impact the investment in associate. If you don't know, you will not be able to reconstruct the account fully, that means you won't be able to get the correct balance sheet account, the correct cash flow number. So that is the beauty of cash flows. You need to know all your work, but you need to be able to reconstruct the T account. You need to know every transaction that could go through the T account. Because once you do know that, you will know where to slot in stuff and be able to get the correct cash flow number. Okay, so remember, what can increase investment in associates is a bargain purchase, is share of associates' profits, or share of associates' other comprehensive income. It is an acquisition of an associate. What can decrease an associate is, or what can decrease the investment in associate is a disposal, is dividends, is an impairment. Okay, so in this case, we have bargain purchase, we have an acquisition, and we have an impairment. They never told us about the dividends. They never told us about the share of associate. They're telling us there's no other acquisition, and they're telling us there's no other disposal. So there's no disposal, and there's only one acquisition. And we have a bargain purchase, and we have, what do we have over there? We have bargain purchase, and we have an impairment. But they never told us about the dividend, and they never told us about a share of associates' profits. If there's no other place regarding about the dividends, then that means there was no dividends. Then the balancing figure can only be share of associates' profits. Share of associates' profits is a non-cash flow number. Now we go to property, plant, and equipment. Company in the group sold plant and equipment for a cash amount of 654. That you must highlight. That is the cash flow number. So immediately in the cash flow statement, you're going to say proceeds from disposal of equipment, 654,000. Remember, we are dealing with a cash flow. We're dealing with a cash flow statement. Whenever you identify cash flow statement, a cash flow number, you need to go slot it in. We're still reading the scenario, so you don't have to go slot it in now. After we read the scenario for the first time, we go set up the cash flow statement. Then we do step 1, step 2, step 3. Because the cash flow statement is set up, the moment you identify a cash flow number, immediately you go plug it in to the cash flow statement. You're only going to get marked if the number appears in the cash flow statement. So take note, there they're telling you companies in the group sold plant and equipment for a cash amount of 654. So that amount, you take it straight to the cash flow statement under investing activities because it's PPE, and we're going to say proceeds from plant and equipment 654. The carrying amount at the date of sale was 465. The profit or loss is included in other expenses. So now we need to calculate profit or loss. We need to calculate profit or loss. How do you calculate profit or loss? Proceeds less carrying amount. You can see proceeds is more than carrying amount. So there's a profit that was made. The profit is included in other expenses. Okay. So what they're trying to tell you, they probably, so most stuff is going through other expenses. Then they're saying the total depreciation for the year on PPE amounted to 233. So what we can do, we're going to reconstruct the T account. You have opening balance PPE, closing balance PPE. Remember, PPE can increase to you as a result of an acquisition, as a result of revaluation, and a result of borrowing costs. The PPE can decrease as a result of depreciation, impairment, disposal. Okay, so those are the typical items. I mean, there's more stuff, but those are the typical items. They're giving us a disposal. Now remember, this is where the key thing you need to take note. The disposal amount in the cash flow statement must be the cash disposal amount. When you reconstruct the T account, the disposal amount that we use is the carrying amount. Very important to see that separation. Okay. And they're giving us depreciation. So if there's no other impact on PPE, then the balancing figure will most likely be an acquisition. Okay. So if the account does not balance, the likely amount will be an acquisition because there's no other items that are giving us that impacts PPE. Okay, now we have financial information, and here they're giving us the income statement. We said that the income statement was not 100%. I mean, they never gave us the income statement, so they needed to give us the income statement somehow. And here they're giving us the income statement. So we have revenue, cost of sales, other income, other expenses, finance costs, share of associates' profits, So they're giving us share of associates profits. So we will be able to insert that in the investment in associates T account. And if there's a balancing figure, it can only be dividends. Okay. Then we have marked income tax. So when you do all of that from revenue up until income tax, you should be able to get profit for the year. Then we have mark-to-market reserve for the current year, and then we should be able to get total comprehensive income. But now they're giving us the profit that is attributable to NCI, and they're giving us other comprehensive income that is attributable to NCI. Then we have investments in group companies. Horoscope held investments in the companies listed below, as well as various other investments throughout the financial year. So investment in Gemini. On 31 December 2018, so it's not in the current financial year. Our current financial year, 1 July. No, it is the current financial year. It was 1 July 2018 to 30th June 2019. So 31 December 2018 is in the current financial year. On 31 December 2018, Horoscope Ltd acquired a 75% interest of the ordinary shares for a cash consideration of 1.5 million rand. So that amount must come through in the cash flow statement. Where in the cash flow statement? It is an investment in a subsidiary. An investment in a subsidiary will fall under investing activities. So under the investing activities, you will say acquisition of subsidiary, 1.5 million rand. That's the cash amount. And a second cash payment of 500,000 rand to be paid on 31 December 2020. That is outside of our financial year, because that is our financial 30th June 2019. Horoscope obtained control. Okay, cool. All assets and liabilities of Gemini were considered to be fairly valued. No additional assets, liabilities, or contingent liabilities were identified at the acquisition date. The equity at acquisition date consisted of share capital and retained earnings, respectively. Okay, so they said there was goodwill. What they need to do, they need to give us the assets and liabilities that were acquired. The reason being is we need that to reconstruct our T accounts. So here they're giving it to us. In the cash flow statement, they're going to give you this because we need this to reconstruct our T accounts. So the following balance were extracted from the trial balance of Gemini Ltd as at 31 December 2018. Property, plant, and equipment. So when we reconstruct PPE, we're going to have to, on the debit side, PP is increasing with the acquisition of a subsidiary. Same for trade payables, same for trade receivables, same for inventory, same for trade payables, same for deferred tax. Then there's a bank overdraft, and then there's debentures. What you must know that debentures with bank overdraft, whenever we deal with bank, the cash flow amount must be the cash we paid 1.5 minus any bank balance. If the bank balance is a debit, if the bank balance is a credit, I think we will be able to decrease the cash balance. Okay, so it will be 1.5 minus 75,000 rand, but I'll confirm that just now. But when it is a debit balance, you will always subtract the debit balance. You will say 1.5 minus the debit cash balance. If it's a bank overdraft, I'll just confirm that just now. Then we have investment in Virgo. Horoscope Ltd acquired 80% of the issued share capital of Virgo on 31 January 2017. So 31 January 2017 is not in our financial year, and obtained control, okay, on 30th November 2018. That is in the control, that is in the current year, right? Horoscope sold 20% of the issued shares of Virgo for a cash consideration of 2.5. So you must know that cash consideration needs to come through somewhere in the cash flow statement. The accountant included the profit or loss on the sale of the shares under other expenses in the consolidated statement of profit or loss and other comprehensive income. You may assume that the tax implication, if any, were correctly treated. Horoscope still had control over Virgo after the sale of the shares. So here we have a change in ownership. Remember, if you watch the previous cash flow, if you were in the class in the previous cash flow, we went through how to deal with change in ownerships. So remember, there's going to be two types of scenarios with change in ownerships when you come through cash flows. Number one, it is going to be where you, before and after the change in ownership, you still a subsidiary. Now, when that is the case, remember, that is considered to be a transaction amongst owners. So before and after the change in ownership, you are still a subsidiary. That is considered to be a transaction amongst owners, a transaction between parent and NCI. Parent is an owner, NCI is an owner. They are equity stakeholders. So that is a transaction with the owner. A transaction with the owner, any cash flow transaction over there goes through financing. Because remember, under the financing activities, it is all equity and all long-term interest-bearing debt. The financing activities only focuses on cash flows relating to financing your capital structure, which is all equity and long-term interest-bearing debt. So because a change in ownership where before and after you are still a subsidiary, that is a transaction with the owners. So that is a financing transaction. So that cash flow of 2.5 will go through the financing activities. So because we sold 20%, so we're making money. When we make money, we say proceeds. So the line item under financing activities will be proceeds from decrease in shareholding or proceeds from sale in shareholding. So it doesn't matter, but proceeds, you want to say that you have decreased your shareholding or you have sold part of your shareholding. So remember, when you have a change in ownership, and the change in ownership is before and after still a subsidiary, then it is a financing activity. So this year, before and after you are still a subsidiary, so it's a financing activity. So that 2.5 million will go through in under financing activities as proceeds from sale in shareholding or proceeds from decrease in shareholding. Then what's critical to take note, remember, any transaction with owners, any profit, any gain or loss, any profit or loss should not go through the income statement. So here they're telling you that the accountant included the profit or loss in the income statement. So we're going to have to take it out. Okay, so we're going to have to take it out from there. Very, very important. We're going to have to remove it from other expenses because a gain or loss that is as a result of a transaction with the owners cannot go through the income statement. Okay, so this is where this information over here will help us to determine the gain or loss on the transaction. Okay, so we will deal with that just now. Then we have investment in Taurus. Horoscope Ltd purchased 55% of the shares and voting rights of Taurus Ltd for 2.2 million on 1 April 2016. So that is outside of our financial year. As part of its diversification strategy and obtain control, okay, all assets and liabilities were fairly valued and there were no additional, okay. You may assume a goodwill was correctly treated on the acquisition date. Okay, so they're not telling us whether it was a cash article 50 of the same. Okay, they're not telling us whether it's cash or not. If they're silent, you can assume it is cash, but we'll see what they say. Okay, so the equity of Taurus on the different dates were as follows. They're giving us the different dates. So they say the directors of Horoscope Ltd decided to sell its controlling interest in Taurus on 1 March 2019. 1 March falls within the current financial year. right? Horoscope Ltd disposed of 45% interest in Taurus Ltd for 2.5 million, resulting in a remaining interest of 10%. The remaining interest of 10%, the remaining 10% interest had a fair value of 750 on 1 March 2019. The settlement amount consisted of cash payment of 2 million and inventory valued at 500,000. The disposal of the interest did not comply with IFRS 5. Okay, cool. So what you must understand is a disposal of 2 million. So that, a cash of 2 million. So the total disposal is 2.5 million. 2 million is cash, 500,000 is inventory. So what you must know is that the 2 million, the cash amount will go through through the cash flow statement. So because in this scenario, so in the previous scenario, it was a transaction with owners, because before and after we are a subsidiary. So that's a transaction with owners. So that goes through in the financing activities. In this scenario, before the transaction, we are a sub. After the transaction, we are no longer a sub. So that is not transaction with the owners. So this cannot fall under financing activities. So this transaction will fall under investing activities. So under investing activities, what do we have? We will have proceeds from disposal of sub. So what we'll say, proceeds from disposal of sub, 2 million rand. Okay, very important. What we will do, however, you must reduce the 2 million rand, the cash amount, if there is any cash amount sitting in the account. So for example, so if there is any cash, we will say 2 million rand minus the cash amount of the subsidiary. Okay, so what we will do, so they're giving you they're giving you all the balances over here of the various accounts, because remember, when we reconstruct the T account, we're going to have to reduce PPE with the disposal of the subsidiary. In the same way, we're going to increase PPE with the acquisition of the subsidiary. Okay, so here you can see these amounts will reduce every balance with these amounts over there. So just take a note. Okay, so they say Taurus declared a dividend of 89,000 Rand on 30th of June, which is already included in other income. Okay, cool. Remember, we only get 10% of it because at 30th June 2019, we held 10%. So included in other income is 8,900 Rand. Okay, so here we have other information. So other information, it is the accounting policy of Horoscope Ltd to account for investments in subsidiaries, associates, and joint venture at cost price. Okay, so we're happy with that. Investments in other investments other than subsidiaries, associates, or joint ventures are measured in accordance with IFRS 9 financial instruments. Horoscope Ltd irrevocably elected to present subsequent changes in the fair value of investments in other comprehensive income. Okay, so remember, when you have normal financial instrument investments, and they are investments in shares, then a company may elect to measure fair value gains or losses through other comprehensive income, and that is what they decided to do. Okay, so they say Horoscope elected to measure non-controlling interest at their proportionate share. Cash flow from interest and dividends are classified as operating cash flows by the Horoscope Group. Remember, in the previous video on cash flows, I explained that what we usually did before CTA is that we always included interest received, interest paid, dividends received, dividends paid under operating activities. That is correct. However, in CTA, we apply the cash flow standard IS7 in its fullest. So IS7 gives you the option to include dividends paid and interest paid under financing activities, and gives you the option to include dividends received and interest received under investing activities. So if the company elects to do so, then you must include interest paid and dividends paid under financing activities, and interest received and dividends received under investing activities. But here they're telling you that the company's policy is to include it under operating cash flows. So therefore, we don't have to worry about including interest paid and dividends paid under financing and interest received and dividends received under investing. We can include everything under operating. So just take note of that. Okay. Then on 30th of June, Horoscope Ltd declared a dividend of 550. That doesn't mean they paid. We have to work out what they paid. Assume normal income tax. Okay, we have that. There were no other acquisitions of disposals of investments. Okay. Other income consists of dividends received from investments in equity instruments. So what they're telling you, other income is only dividends, and then all other income is included in other expenses. Goodwill is tested for impairment annually. You may assume that there was no indication of impairment at 30th June 2019. So there's assume a pre-tax market discount of 10% compounded annually. Horoscope recognizes any differences between the amount by which non-controlling interests are adjusted and the fair value of the consideration paid or received directly in changes in equity ownership reserve. Changes in ownership reserve in equity. Okay, whatever that change in ownership. Yeah, okay, we know what that is. Okay, so that is basically it. So now we're going to look at part 2. So now we're going to deal with this 44 marker. They say prepare the cash flows, prepare the consolidated statement of cash flows of Horoscope Ltd for the year ended 30th June 2019 using the direct method. So we must prepare the consolidated statement of cash flows. So we're going to do that. We're going to set up the format, and then we're going to go through the scenario again. So once we set up the cash flow statement, we now do step number 1, which is open up the T accounts. We now do step number 2, go from each scenario, go from each additional information and get the number. As we get the cash flow number, we go slot it in the cash flow statement immediately, and then we move on like that. Okay, so they're telling you this. Please note, no other notes to the consolidated cash flows are required except as specifically required above. Round of all amounts of the nearest rand. Comparators are not required. The amounts for cash receipts from customers and cash paid to suppliers and employees must be calculated. Okay. You must comply with international financial reporting standards. Okay. So let's have, so I'm going to go over now to, cash flow, to the drive. So do you have any questions while I open up the drive? Bernice, Karen, Faid, Rebecca, any question at this point?
No question.
No questions.
No questions.
No questions.
Okay, so this you should be able to see Excel. So this is the Excel we went through when we went through the scenario. When we went through the scenario last time, in the previous cash flow video, where we just went through the summary. So I'm going to use the same workbook and I'm going to answer the question now. Okay, so I will just say here, so this is horoscope. Okay, so it's stat letter 106 2020. Okay, so horoscope letter 106, 2020. Okay, so remember what you want to do. So now that so the strategy in an exam, and this is particularly important for CTA level 1, which you're probably going to get a 40-marker question. Okay, probably going to get a 30-marker, between 30 about 30 marks cash flow question for CTA level 1, which you only cover cash flows, and then there's, I think, integrated reporting will be like 5 marks. So this strategy is particularly important for you. Why? Because you're getting a full cash flow question. For CTA level 2, you're most likely not going to get a full cash flow question. So what you're going to do, you're probably going to get an aspect of cash flows, either financing or investing or something like that. So you won't exactly set up like this, but you will set up the component that you need to focus on. So it's the same level of thinking, but slightly different. For CTA level 1, you like the chance is basically 99.9% of the chance that you're going to get a full cash flow question, because that's the only topic you're doing with integrated reporting. There's no way they're going to give you a 30-marker integrated reporting question. So for CTA level 2, 20 marks most likely, or just under 20 marks will be cash flows, around 20 marks, because the other 20 marks is going to be on foreign subsidiaries. So what's going to happen? They will probably ask you for an aspect of cash flows. So you must be able to work, be able to use the same level of thinking or the same way of thinking, but for that aspect that they ask you. So when they do a cash flow question, they're going to say, dear student, prepare. So for CTA level 1, they're going to say, dear student, prepare the statement of cash flows. So with any financial statements, there are 3 things you need to do: company name, statement name, and then the date. So company name, it is Horoscope Ltd. Statement name, we're dealing with groups. So when we're dealing with group statements, we always include the term consolidated. So we can say consolidated. And now the statement name, statement of cash flows. Okay, remember in every financial statement says for the period ended. What is our period? It's a year. So it is for the year ended. So all the financial statements have for the year ended except the balance sheet. The balance sheet says as at. So as at which date, or for the year ended which date. So then you put your date next to it. I just put my date below, which is 30th June 2019. In an exam, you can just say next to for the year ended 30th June 2019. If it's a balance sheet, as at. So statement of financial position as at, not for the year ended. So remember, the balance sheet is at a point in time, where all the other statements is for the year. It takes into account transactions for the year. The balance sheet represents balances at a point in time, and that is why we say as at. They're very particular over those wording, so make sure you don't lose the 1-mark communications because you said for the year and not as at, or you said as at and not for the year ended. So that is part of the communications over here. Remember, 1 mark can separate a lot. 1 mark in 1 divided by 40 is a good 0.25%. The 0.25% is a lot in this context. So just take note of that. Okay. So not 0.2, it's 2.5 times 100. Yeah, so 1 mark is 2.5%. 2.5% is a lot in this context. So just take note that 1 mark communications goes a long way. Now you want to set up the cash flow statement. Remember, like I said, what we're ultimately trying to do, we are explaining to the users of financial statements how we have generated and utilized cash flow. Ultimately, what we're explaining to users of financial statements, so we want to get to cash and cash equivalents, cash and cash equivalents, end of year. We want to get to this point, right? So we want to get to this point. So we're going to have those numbers, okay? So we will have that numbers, and we want to get to that point and we're gonna have cash and cash equivalents start of year. Okay, you can use proper terminology. You can check how they word it in the solution. I'm not gonna still worry about that. So remember, something plus the opening balance of cash and cash equivalents will equal the closing balance. What is that something? That something is, what did I call it? What did I call it? Can't I remember? Yeah, so that company, that thing is called net movement in cash and cash equivalents. Okay, so what is the something? So net movement in cash and cash equivalents plus the opening balance of cash and cash equivalents is equal to the closing balance. That is what we're working towards. So how do we get this net movement? That net movement is an explanation to the users of financial statements, telling them how we have generated and how we have utilized our cash flow. And we split it into three parts. We split it into an operating activities part, a financing activities part, and what was the other one? And an investing activities part. Okay, so remember, this D is equal to A plus B plus C. So now we're going to deal with that. Okay, so we're going to have cash flows from operating activities. So like we explained in the previous video, cash flows from operating activities has two parts. It has cash generated from operations, and then it has everything else. What is everything else? It is interest, dividends, tax. Take note, interest and dividends can be disclosed elsewhere, can be disclosed either under financing or investing, but in this scenario, they're telling us that interest and dividends is included under operating activities. But now remember, operating activities has two parts, cash generated from operations and the interest, dividends, and tax. What you must know, that cash generated from operations can be determined in two ways as well. It can either be calculated using the direct method, or it can be calculated using the indirect method. In this question, they want us to do it using the direct method. So how do we calculate cash generated from operations using the direct method? It will be cash received from customers, cash paid to suppliers, and employees. That's whatever you want to call it. Okay, so remember, now we get the first part. The first part of the cash from operating activities is cash generated from operations. Okay, so here we go. Cash generated. If it's a negative, then it is utilized from operations. Okay, so that's the first part. Everything else, it's going to be interest received, dividends received, interest paid, dividends paid, and then tax paid. Okay, and this is going to give us what we're looking for. Which is cash generated. If it's positive, it's generated. It's utilized if it is negative from operating activities. Okay, and this here is A. Okay, so that there is A. Now we do the rest. Now we're going to have cash flow from investing activities So if you're writing an exam on Excel, then you kind of have a format already. Okay. Cash flows from investing activities. We don't know what are the investing activities, so we leave like 7 lines. Then we're gonna say cash generated or utilized from investing activities. So with investing activities and with financing activities is not like a set format. We have to see what the scenario have. But because we read the scenario, we already know there's a disposal of PPE, so we can have proceeds from disposal, from sale of plant and equipment. We already know there's a disposal of a subsidiary. We also know there is a investment, acquisition of a subsidiary. So we already know those 3 things. There may be an acquisition of PPE as well if we reconstruct the T account. So the 3 things we know, there's a disposal of PPE. So we call it proceeds from PPE. We know we dispose of a subsidiary. So we know there is a proceeds from disposal of subsidiary. And we know we acquired a subsidiary in the current year. So we know there's going to be acquisition of a subsidiary. Those are the 3 things you can plug in because we know we read it. Then there may be investment in other equity instruments. There may be a disposal in other equity instruments. There may be an acquisition of a subsidiary. We don't know yet. They never told us. But by reconstructing the T account, we may be able to figure that out. Okay. Okay, so investing activity, cash flows from investing activities. So we're going to leave that blank for now. And this here is B. Okay, and then we're going to do financing activities. Okay, so there we have cash flows from financing activities. Financing this is going to be C. Okay, so net movement is A plus B plus C. So this over here, you simply just say A plus B plus C. Okay, so there we go. That's going to be that. Let me just do this. Okay, so now we have the cash flow statement set up. Now that the cash flow statement is set up, as we go through the scenario again, we will slot in whatever we can. Okay, so now my format is set in. Now remember, I took a bit long. You must set this up in like in a minute. Okay, so you must set this up in like in a minute, 2 minutes, not more than 3 minutes. You can't take a whole day. So you must set this, you must set it up like literally within a few minutes. Okay. So like I said, you want to set this up literally in a minute or 2. You don't know, 5 minutes is too long. Okay, so do it really, really quickly. Now we can deal with the actual scenario. Okay, now we can go back to the scenario. So I'm going to do my workings on a separate page. Okay. So I'm just to, what do I do here? Where is that now? So I'm going to say workings. This is horoscope. Okay. Okay. Okay, so there's my workings now set up. So now we can go. So now we're going to go back to the scenario. Where is this now? Okay. So the what you want to do, what you want to do is that I'm not going to do that now because it's going to take too much time for me. What you're going to do, you want to open up a T account for each balance. Step number 1, open up a T account for all of those trial balances over there. I'll tell you why. So you only open up a T account for every balance sheet account. So that is assets and liabilities, definitely. And then do it also for equity. Although equity is not necessarily so important, but do it for equity as well. So what you're going to do, you're going to open up a T account for every balance sheet account, assets, liabilities, and equity, opening and closing. That is step number 1. Don't forgo step number 1. I'm going to start with step number 2. So with step number 2, you will then start with the additional information and then read through the additional information. As you read through the additional information, whichever cash flow figure we get, we slot into the cash flow statement. And as we read the additional information we reconstruct our T account. Okay, so that's very important. Why is step number 1 important? Because remember, you must think about you in a scenario where you are under exam pressure. So once you're done with additional information, the chance of you going back to your balance sheet or your trial balance is highly unlikely. So by having all the T accounts, you will be able to see at a glance which T account is not complete. And you're going to have to complete the T account to ensure that there's no other cash flow number. So that's very, very important to take note. Okay, so I'm not going to do step number 1. I'll do step number 1 as I do step number 2, because I know I must go back and go have a look at all of these line items. Okay. So just so you can see here, they're giving me cash and cash equivalents. Okay. So closing balance 99, opening balance 255. So I'll go plug that in now. So 255, 987. So if I go 255, 987. So I will go over here, 255, 987, that was opening. Closing balance is 99588. Let me just see if I got that right. 99588. What did I say? Yes. Okay. So remember, how are you going to know if this works? Basically, that plus that so net movement plus opening balance minus closing balance must come to 0. Okay, so that is basically, so as you can see, this needs to be 155. This needs to be 156, 399. I'm doing something wrong here. Sorry, let me just undo that. Undo. I'll show you, I'll just figure out the formula now. But anyway, we'll figure that now. So I plug that in. So here's probably a half a mark you're getting for this, or 1 mark, I don't know. So it's either 1 mark or half a mark you'll be getting for this over here. So now let's go and, so what you do, step number 1, you're going to open up all your T accounts, plug in opening balance, plug in closing balance, only for balance sheet accounts, only for statement of financial position accounts, assets, liabilities, equity. Now you go do step number 2, and we start with additional information number 1. With additional information number 1, what are they saying? They're saying the investment in associate. So we're dealing with investment in associates. So what do I know? I know I'm going to have to deal with that account, investment in associates. Okay, so I'm going to go and open up investment in associate T account. So under my workings, so I'm going to have working 1. I'm going to have investment in associates. I'm not going to do up a T account. It'll take too long for me on Excel. So I'm going to use like a note disclosure format. Okay, so what I'm going to do, I'm going to say investment in associate. The way you set it up over here, the way you think about it, if an amount goes on the debit side, it is positive. If an amount goes on the credit side, it is negative. Okay, so if an amount goes on the positive, if the amount goes on the debit side, it's positive because it increases the account. If it's as a plus, if it is on the credit side, you make it a negative amount. Okay. So what can increase? So we're going to have opening balance. So it's going to be opening balance, and we will have closing balance. Then we want to have a look at anything that can increase the T account. So remember, what can increase an investment in associate? An acquisition, share of associates' profits, a bargain purchase. What can decrease an investment in associate? A disposal of an associate, dividends, and an impairment. Okay, so just take note of that. So let's go and read note number 1. So because I note number 1 is about investment in associates, I want to plug those numbers in quickly. So opening balance 598,650. So as an asset, so an opening balance on the debit side, I keep all my debits as positive 598,650. Because it's an asset, the closing balance is on the credit side. I keep all my credits as a negative. Okay, so credit, where's credit over here? 1281,118. 1281,118. 1281,118. Okay, so you can decide. So just make sure, just check that I obviously have my numbers correct. Okay. Okay, now I read my note disclosure. Now I read additional information number 1. So they say on 1 May 2019, that's in the current financial year, Horoscope Ltd acquired 40% interest in Liberum for a cash consideration of 405. They're giving me the cash consideration. Immediately, I go to the statement of cash flows. That is why it's important to first set up the statement of cash flows. So an acquisition of an associate is an investing activity. So what do I just say here? Acquisition of associate, and then I put in a cash amount. Because I acquired an associate, it's an outflow. Outflow is negative, inflows is positive. 405, 123. Okay. So this here is basically, you don't have to tell them this. I'm just saying it for our purposes. It is given. So remember, as soon as you get a cash flow number, you go plug it in. So that was given first. We immediately plugged it in. So we acquired for a cash consideration of 405. So in my workings, I need to reconstruct. So here is acquisition. And remember, in the T account, we don't care whether it's cash or not. We want to have it at the cost price. So the cost happens to be the cash amount. So, so the acquisition is a cash amount of 405. Remember, this is a credit. There's a credit balance. I'll make it negative. So remember, the closing balance of an asset is always on the credit side. All my credits are negative. Acquisition of an associate increases an associate. An associate is an asset, so assets is increasing. Assets increase on the debit side, so I leave it as positive. Okay, so that's what I plugged in over there. So they say a horoscope Ltd exercise significant influence. Okay, we're happy with that. The equity of Liberum Ltd consisted of share capital and retained earnings, respectively. Any excess that may have resulted from the acquisition was included in other expenses. Any excess included in the acquisition was included in other expenses. Okay, so what we'll have to look over here is the following. We need to work out whether there is a goodwill or a bargain purchase. Because they're telling you it is included in other expenses, what must you know? That we need to reduce other expenses. Okay, so let's quickly work out whether there is a bargain purchase or not. So to calculate bargain purchase, what we're going to do, we're going to work out total equity. So it is share capital, retained earnings. There's no fair value adjustments. There are no fair value adjustments. So basically, this is the fair value of net identifiable assets. So it was 250. You can just I'm just remembering. So just make sure I plug in the right numbers. 850. Okay. So therefore, fair value of net identifiable assets is the sum. Now we acquired 40%. Okay, so 40%. It's going to be that times 40%. Okay, so it's 440. How much did we pay? Consideration. Consideration 405. 1, 2, 3. So what do we say? Consideration minus the amount. So here you can see the consideration is less. We paid 405,000 Rand for something that is worth 440. So therefore we made a gain. So this here is a bargain purchase. If we paid more, then it would have been goodwill. Okay, so bargain purchase. So bargain purchase, it is 35,000. Okay, so we must include over here bargain purchase. A bargain purchase increases investment in associate. So it's going to equal to that over there. Okay, 35,000. And I'm going to say it is working too. So this is me reconstructing the T account. Okay, so very important to take note. What you want to just be aware, we're going to have to bring this into other expenses. So remember, included in other expenses is a bargain purchase of 35,000 Rand. We are busy with cash flows. What we want to do, we want to get expenses to be a cash flow expense. So that is why we're going to have to make a necessary adjustment. So just take note of that. Okay, so what I will do is, so I don't forget, I will do working 3 and I'll do the expenses calculation. So what do I do? I go to the income statement. I read the scenario, so I have an idea of the scenario. So I know under one of the notes, there is the, so here we go. Other expenses, I'm going to take that number. So other expenses, I'm going to take that number, 9558778. Okay, so I'm going to take expenses, 9558778. So what am I going to do? This is a bargain purchase. Okay, so bargain purchase. A bargain purchase is included in other expenses. Now, this other expenses has two amounts. Okay, so this other expenses has two amounts. It has non-cash flow amounts and it has amounts that is disclosed elsewhere. The purpose of the expenses amount is twofold. I want to get expenses that is cash, and I want to get expenses that is relating to operating activities. So that's the whole purpose of the expenses calculation. It's twofold. The expenses amount needs to represent cash expenses, and it needs to represent cash expenses relating to operating activities. Now, included in the 9557 would be expenses that is of a would be income and expenses that is of a non-cash flow amount, and it's going to include amounts that is non-operating. It will include amounts relating to investing activities. It will include amounts relating to financing activities. But we don't want it in our expenses amount because we want to get to an operating expenses amount, an operating cash expense amount. So ultimately, what we're trying to get to is the following. We want to get to cash operating expenses. So just take note, that's what we want to get to. Now, included in 9,558 is a bargain purchase gain. Okay, so included in 9,558 is bargain purchase gain. What did I just do? Is a bargain purchase gain. Okay, now a bargain purchase gain is a first is a non-cash flow, and also it is an investing activity. We don't want it in the expenses amount, so therefore we need to remove it. Now, it's very important to understand that the bargain purchase is an income. So what did it do to expenses? It reduced expenses. So therefore, to remove it, we need to add it back. Okay, so take note. Bargain purchase gain is a gain, meaning an income. So it is included in other expenses. Okay. So the bargain, the other expenses is given to us of 9,558,778. Okay. Now, what we're trying to say is included in other expenses is the bargain purchase gain. The bargain purchase gain is an income. So what did the income do to expenses? It reduced expenses. We don't want it to be in other expenses. Why? We are aiming to get to cash operating expenses. Firstly, a bargain purchase gain is non-cash flow. Secondly, A bargain purchase gain is an investing activity. We want to get to operating expenses, so therefore we need to remove it. To take it out of other expenses, it initially reduced other expenses. So to take it out, we need to add it back. So then I plug it in, 35,000 Rand. So as you can see, the reason why we set up T accounts is so that we can, as we work through the additional information, we slot it in wherever necessary. The only T account or the only calculation that will not be a balance sheet is going to be this expenses calculation. Okay, so just take note. So it's not really a T account, it's just a calculation. So this is very important to take note. But we are still on additional information number 1. We are using additional information number 1, and we're slotting in the numbers everywhere it has an impact. And that is why it's important that you know basically you must know all your other topics in order to be effective in cash flows. But what I can tell you, after you do this question, after I'm done with it, then you redo this question. Follow the same thinking approach, and no matter which cash flow question you get, you'll be able to handle it. So if you do about 2 to 3 cash flow questions, including this one, then so that means 2 more. Like my past students, that was in FAC 1, because FAC 1 is basically 30 marks is cash flows in your test. They get, like the one person that told me the results that I remember got like 70, the other person got like 80, because of there's a set way of thinking about cash flows. It may seem long, but in the end, it's going to save you time, and in the end, you're going to get close to 100% for cash flows. So make sure you work through this again, and that you're able to handle it. For CTA level 2, the same approach, but obviously your paper is not going to be so much on cash flows. So although you can get close to 100% for cash flows, the thing is you don't know how much cash flows is going to be. Okay, so just be aware of that. So now let's go back to note number 1, additional information number 1. So we brought in, we can see over there that we brought in, we had the opening and closing balance for investment in associate. We brought in the 405,000 Rand. So they say equity and labor considered retained earnings. Okay, and through this, so this paragraph completely done. Why? We brought in the 405. We plugged in the 405 immediately in the cash flow statement. We also included it in the T account of investment in associates, because we need to reconstruct investment in associates. Then we worked out the bargain purchase gain, because they told us that there was an excess, and the excess amount was included in other expenses. So now we reconstructed the T account. Whenever there is a bargain purchase, the bargain purchase must be included in the investment in associate T account, and it increases investment in associate. We did that. But we also know that the other side, it is debit investment in associate and credit other expenses. So other expenses was credited with the bargain purchase. We don't want it in other expenses. So therefore, immediately we also remove it. We don't wait till we come to other expenses, because we most likely will forget about it, or we're going to have to go back to additional information number 1 to go find out that number. So right while we do additional information number 1, we impact all the balances, all the accounts that is impacted with the information of additional information number 1. Just take note of that. Now they say on 30th April 2019, there were indications of impairment in respect of Leo Ltd, another investment in associate. On 30th April 2019, the value in use and fair value less cost to sell. Okay, so there's an impairment. Any impairment loss was included in other expenses. So there is going to be an impairment loss. So now we need to work out the impairment loss. Okay. So working for. So working for, remember how we do an impairment loss? Carrying amount less recoverable amount. Recoverable amount is the higher of value in use and fair value less cost of disposal. Okay, so value in use was 250. Cost of disposal was 233. Therefore, the recoverable amount is the higher, so it's going to be value in use. Okay. The carrying amount was given as 275, I think 583. Let me just check. 275, 587. 275, 587. So when carrying amount exceed recoverable amount, there is an impairment loss. Okay, so here we're going to have impairment loss. So when the carrying amount exceeds the recoverable amount, there will be an impairment loss. When the carrying amount is less than the recoverable amount, there is no impairment loss. So impairment loss, we're going to say equal that minus payment loss equals that minus that. Okay, so the impairment loss 2587. So what do we know? An impairment loss reduces it reduces investment in associate, so therefore we make it negative. Okay, so it's a credit to investment in associate, and we can say working for. Now, an impairment loss is an operating expense. An impairment loss is an operating expense, but an impairment loss is non-cash flow. So therefore, we're going to remove it. An impairment loss is an operating expense, but we don't just want operating expenses, we want cash operating expenses. So therefore, because an impairment loss is non-cash flow, we need to remove it. An impairment loss increased other expenses because an impairment loss is an expense. So to remove it, we need to subtract it. Okay, different to an income. An income, we're also removing, but an income reduced expenses. So to remove it, we add it back. An impairment loss, non-cash flow, so we want to remove it. An impairment loss increased expenses, so to remove it, we subtract it. Okay, very important. So note number one, we are sorted. Note number one, we are sorted. Okay, so we included everything. Now, what we must know, what also impacts share of associates profits. So remember, so they say horoscope did not acquire or dispose of any other investments in associates during the current financial year. Okay, so they didn't. So we need to balance this whole thing. Remember, what can increase an investment in associate? Acquisition, bargain purchase, and share of associates profits. Okay. What can reduce an investment in associate? A disposal, dividends, and an impairment. Now I'm going to put in disposal over here just to make it complete, but we're going to make it 0. Why is it 0? Because they told us there was no disposal. There was no other acquisition other than what was told us. Okay. So now we must bring in share of associates profits, share of associate profits. We know it was given to us. So associates profits increases, so we're going to leave it as positive. If we go to the financial information, share of associates profits is 355,855. 355,855. 355,855. So if I add up all of this, if it comes to 0, the account balances. If it does not come to 0, the account is not balanced. Then that means there's something still missing. Okay, so I'm going to add up. Okay, balance should be 0. If it's not 0, then something is still missing. So it is, there's something missing. So the only thing it can be would be dividends. Okay, so we never brought in dividends over here. So we're going to bring in dividends. Dividends can only reduce. So we're going to say dividends. Dividends. So this is going to reduce. So I'm going to make it negative 87,800. Okay, so there are the account balances. So what you must know, we have to factor in this dividends later on. Okay, so just keep in mind. So with dividends, it's easy. Okay. Because you're going to come to a place where we're going to deal with all dividends. So it's going to be easy to find it out. Okay, so you just want to make a note. So on your page or over here, you want to maybe highlight this. So what I will do, I will highlight it in orange. I'll choose a color. So I know I'm not yet done with it. Okay, so now I know any orange, I'm not yet done. Once I unhighlight the orange, then I'm done with it. So dividends, I know I must still work through when we come to dividends in its totality. Okay, then, so that's all so far. Now we go on to the next note. Now we go on to the next note. Note number 2. So note number 2, we say property, plant, and equipment. Property, plant, and equipment, companies in the group sold plant and equipment for a cash consideration of 654. So now I go straight to that and I go to the, so property, plant, and equipment is investing activities. You can watch the previous video to identify what is investing, what is financing, what is operating. Okay, so it's so we sold. So therefore we say proceeds from sale of plant and equipment. Okay, so it's proceeds, money is coming in, so it's positive 654,850. Okay, so this is also given. Plug in as soon as you get it. Probably half a mark. So far we have probably 1 mark, 1.5 marks. Okay, so far 1.5 times 1.5 divided by 40 times 100, we have 3.75%. Okay, so far it's better than nothing. Okay, so next, so we dealt with 654. Then they told us that the carrying amount at the date of disposal was 465. The profit or loss on the sale is included in other expenses. And then they say total depreciation for the year on PPE amounted to 233. Now I'm going to go draw up the PPE T account. So remember the first, we're going to draw up the T account. You probably would have had it already. I'm doing it as I go along. So with PPE, I'm going to call it PPE. So opening balance, closing balance. I know there's a disposal. Remember, the disposal, the proceeds in the cash flow statement is the cash amount. The disposal we want here is the carrying value. Okay, so remember it needs to be carrying amount. Okay, then they gave us depreciation. So what can increase PPE is acquisitions, is like revaluations, and don't forget an acquisition of a subsidiary. What can decrease PPE? Disposal, depreciation, impairment, and a disposal of a subsidiary. So we know there's an acquisition of a subsidiary. We read the scenario. Acquisition of sub the acquisition of sub will increase. We know there is a disposal of a sub. A disposal of a sub will decrease. Okay, so I'll just leave that for now. And if this balance is 0, then everything is fine. If it's not 0, then that means we're missing something. So the only thing we don't have over here is a normal acquisition. So I'll bring in normal acquisition. Okay. Okay. So now let's deal with opening and closing PPE. So if we go opening and closing PPE, so you just need to help me now with these numbers. 1230, let's see if I can copy it. 731,336. Okay, cool. So remember, an assets opening balance on the debit side, all my debits are positive. Closing balance is on the credit side. My credits I make negative. Okay, then the disposal. Remember the disposal we bring here in at carrying value. The carrying value was given to us of, the carrying value was given to us at 465,082. 465,082. So carrying value decreases. So I'm saying negative 465,082. What was that right? 465,802. 465,802. Okay, so disposal goes on the credit side, therefore make it negative. Okay, depreciation was given as 233,850. Depreciation given to us 233,850. So depreciation goes on the credit side of PPE because it decreases PPE. So therefore say 233,850. Now depreciation is an operating expense, but depreciation is a non-cash flow. So therefore, I take it there and I say depreciation. It's non-cash flow. So depreciation increased other expenses. I don't want it in other expenses because it is a non-cash flow item. So therefore I need to remove it. So the way I remove it, I'm going to say minus 233,850. Okay, very important. Now before you forget, they gave us over here that we sold it for 650 and the carrying amount was 465. So that means we made a profit on the sale. So we need to work out this profit. Okay, so the profit on sale. So what you must know, you don't have to work it out. I'm going to work it out. You can just slot in the number because it's a very quick calculation. There's no need to show a working for it. I'm going to still show a working for it just for completeness purposes. So we're going to say proceeds.
Verified.
Yes.
On the depreciation, they didn't mention that it was included in the total expense, other expenses. Why did you include it?
Okay. So it's nowhere else. Okay. So it's nowhere else. It's not shown separately. So it can only be included in other expenses. Okay. So that is just, I assume you must know that. So with other balances, it could be included somewhere else. So that is why they tell you. So bargain purchase could have been in other income. So they're telling you it's in other expenses. All the others, they're just telling you that it's in other expenses. It's included in other expenses because it may have been included somewhere else. But depreciation, impairment will always be included in other expenses. So therefore you must know you need to take it out. Okay. So we have proceeds. And then we're going to have carrying amount. The proceeds was 654,850. The carrying amount was 465,802. So therefore we know there's a profit on sale. Okay, so therefore we know there's a profit on sale. profit on sale. So the profit on sale is going to be equal to 654 minus 465, which is 189,048. There's no need for you to do the calculation like this. You can simply just plug the answer in and show the calculation in brackets. I just did it like that for completeness purposes. Now they said included in other expenses is this profit or loss. We know it's a profit. Now, profit on sale of PPE is a cash flow. However, it is an investing activity cash flow. We want to get to cash operating expenses. We want to get to expenses that is cash and that is operating. So because the profit on sale firstly is not an expense, but more importantly, it is a investing activity. So therefore, we don't want it in operating expenses. So what we're going to do, included in this 955 is that profit on sale. We don't want it in the 955 because it is an investing activity. We're only interested in operating expenses, that is cash. So therefore, we need to remove it. So profit on sale needs to be removed. Now remember, what did profit do to other expenses? Profit reduced other expenses. Because we don't want it, because we need to remove it, we have to add it back. Okay, so I'm going to add it back. So I need to make it positive. Oh, wait, the number is positive. So I can just remove the negative. Okay, so therefore I add it back and it must be positive. Wait, what did I do? Okay, so I'll tell them working 6. So that is why it's important to, as you go through the scenario, slot in everywhere. Okay, slot in everywhere. Okay, so we know there's an acquisition of a sub. We know there's a disposal of a sub. All we go do, we go fetch those numbers. So somewhere, it's already somewhere. So here we go. This was the acquisition of a sub, I think. We acquired, yep, so acquisition of a sub. So PPE, you can see it's 284, that now 284, whatever the number is. So acquisition of a sub, it's an in a debit, so it's a positive. Then we have disposal of a sub. I go fetch it. So I know it's there. I don't need to wait till I come there. Disposal of a sub, property plant, there we go. So because the disposal is on the credit side, all my credit balances is negative. So now I can add this up. So now I can add this up. If there is a balancing figure, then that means the account is not balanced. If it is negative, if it's 0, then the account is balanced. So the account is not balanced. So the only thing could have been that there's an acquisition. Okay, we have covered. We have opening, we have closing. We have opening, we have closing. We have disposal, we have a disposal of a sub. We have acquisition of a sub. We have depreciation. We have, there was no impairment. They never told us of an impairment. So the only thing that can be is an acquisition of a subsidiary. So we're going to say 7604072. Okay, so now it's 0. So that was the balancing figure. That's acquisition of a subsidiary. They never told, that's a normal acquisition. They never told us about anything else. Okay, they never told us about anything else. So it can only be an acquisition. And they never said that the acquisition was on credit. So we can only assume it is for cash. So now I go to the cash flow statement. Immediately, I go plug in. Immediately on investment activities, I'm going to say acquisition of property, plant and equipment. Okay, so plant and equipment. So it's an acquisition, it's an outflow. Okay, so therefore it must be negative. So there we go. And we're going to say they can go look at working 5. Okay, so these will be the first big marks you are earning because you had to do a calculation for it. Now let's move on. So let me go back to the note number 2. So note number 2, here's note number 2 now. So note number 2, done. Okay, they never spoke about impairment over here, so we have covered everything. So note number 2 is done. Now we come to note number 3, financial information. So here is revenue, cost of sales, other income. So note number 3, that will be the one of the last stuff we're going to check. Okay, but because it's revenue and there's cost of sales, we can work out for revenue, we can work out cash received from customers. Okay, so I'm going to work out cash received from customers now. So to work out cash received from customers, we're going to need trade receivables. So here is trade and other receivables. Okay, so we're going to have to go look at if there's a note on trade and other receivables, because we don't want trade and other receivables. We want trade receivables. We want debtors relating to sales. So for now, let's go and do the trade and other receivables calculation. So I go to workings, working 7. So when it comes to cash and, so we're going to work out cash received from customers, okay? Because I'll come to note number 3 and I see revenue. So there's going to be quite a bit of marks with this, or not really so much. Most of the marks is going to be for cash paid to suppliers and employees. Okay, so that calculation you want to make sure you can get, because that is going to that accounts for close to 10 marks, that calculation alone. So just make sure you know you can do that calculation. Okay, so cash received from customers is a quick calculation. So I'm gonna call it, so this is trade and other receivables. Okay, as my T account. So I'm going to have opening balance as an asset, so opening balance on the debit side, closing balance on the credit side. If I go fetch the number, opening balance. Oh, just another important point. Make sure you look at the column of your trial balance, which is opening and which is closing. Doesn't mean the last column is the opening and the first column is the closing. Make sure you look at the date. Okay, so they sometimes do just switch it around to see whether you actually have a look. So don't be oblivious to that. Don't mess up your whole calculation solely because you put the wrong, you use the wrong column as opening and the wrong column as closing. Unfortunately, people failed because of that. Even though the calculation was correct, but because opening and closing was the wrong way around, they failed the paper because of that. So just make sure you check the column. Don't just assume opening is the last and closing is the first. Okay, don't just assume that. So remember, my opening, my closing balance on the credit side because it's an asset. So I'm going to say negative. What you want to do with trade and other receivables, and the same thing for trade and other payables, you want to go have a look if there's any note on trade and other receivables. Okay, I don't recall seeing a note on trade and other receivables, but you want to have a look. Okay, so there's no note on trade and other receivables, so we're okay. So if there's no note on trade and other receivables, you can assume trade and other receivables relates fully to sales relating to customers. Okay, but if that is not the case, sometimes trade and other receivables may include other things. So then you must take it into account. Okay, so that's very important. Okay, so what can increase trade and other receivables is revenue. Okay, what can decrease trade and other receivables is bad debts. Okay, we don't have bad debts over here, so we can make it 0. We have revenue. Revenue increases trade and other receivables. So it goes on the debit side, so therefore leave it as positive. So what you must know is that over here, because you're busy with groups, you must always have a lookout for acquisition of a sub, and disposal of a sub. Okay, so acquisition of a sub will be on the debit side, so we leave it as positive. So we go again to note number 4, acquisition of a sub. So here is trade and receivables. There's trade receivables, so 123. And then there's disposal of a sub. I think was note 4.3. 4.3 easier. Yes, there's trade and other receivables. Just make sure I have the right numbers, okay? Okay, so that is basically it. What can increase is revenue, acquisition of a sub. What can decrease is bad debts and the disposal of a sub. Okay, so if we add this up, it's not going to balance. Okay, so when we add this up, it won't balance. So the balancing figure is going to be our cash received from customers. Okay, so the balancing figure is going to be our cash received from customers. Okay, so what I'll do, we can go and plug that in. So now we go to the actual calculation, and here we have cash received from customers. I'm going to say equal. The balancing figure is my cash received from customers. So that we'll do over there, and that's going to be working 7. Okay, so it was working 7. So then they can, that's about 2 marks, 2 to 3 marks. Okay, so just take note. Now we can work out cash paid to suppliers and employees. Okay, so now we'll work out cash paid to suppliers and employees. Cash paid to suppliers and employees is huge. Like it can be close to 10 marks. Okay, so cash paid to suppliers and employees. Okay, so this one takes into account. So what you must do, it's going to take into account, you need an inventory. We're going to use the trade payable account. Okay, so we're going to use a trade payable account, but you must also do an inventory calculation. Okay, so what we're going to do, this takes into account, you must do a payable account as well as an inventory count. Okay, so working 9, we're going to use the inventory account. Okay, so the whole purpose of the inventory account is to get purchases. Okay, so the whole purpose over here is to get purchases. So what we're going to do, we're going to have opening balance of inventory, closing balance of inventory. Inventory can increase as a result of purchases and a result of acquisition of a sub. Inventory can decrease as a result of cost of sales and as a result of a disposal of a sub. Okay, the balancing figure is going to be your purchases. The whole purpose over here is to work out purchases. So the balancing figure is purchases. Okay, so our balancing figure is purchases. This number over here is going to deal with, is going to come in over here. Okay, so we're going to bring in purchases. We bring it into cash paid and other suppliers, and we're going to say equal to that number over there, which is working 9. So that is working 9. Okay, so that is purchases. Then what we're going to do, we're going to bring in opening balance of trade payables, closing balance of trade payables. Okay, so now this is important to take note. Trade payables is a liability. So remember what I do is I say my opening balance is debit. I mean, I say my debit is positive and my credit is negative. So remember the opening balance for purchases, opening balance for trade payables is on the credit side. So therefore I have it as a negative. So it doesn't matter how you want to think through it. So what we will do actually over here, we will think about what increases it and what decreases it. Okay, so we'll think of it in that manner. So with purchases, opening balance is on the credit side. So with trade payables, opening balance is on the credit side. Now opening balance increases trade payables. Closing balance on the debit side, and that decreases trade payables. So we will think of it in that manner. Okay, so just take note of that. So what can increase trade payables is purchases. What can increase trade payables is an acquisition of a sub. What can decrease trade payables is a disposal of a sub. Now remember, we are working out cash paid to suppliers and employees. So what we also bring in here, what increases trade payables, but we bring in only the cash amount, is cash expenses. Okay, so remember what increases trade payables is cash expenses. And then the balancing figure will be cash paid to suppliers and employees. Okay, so we're going to do that. So the balancing figure over here will be cash paid to suppliers and employees. Okay, so the balancing figure is what will go to your cash flow statement. So what we're going to do, I'm going to go fetch the number. We're not yet done with the cash expenses, but we're just going to plug it in here so long. So working 3, we're not yet done with it. I don't think we're done with it yet. So this here is working 3. So I'm just going to add it up for now. We'll see if we're done. I don't think we are done as yet. Okay, so far, let's just assume for now it is 9 million. What we're going to do, let's go fetch inventory. So under inventory, we're going to go fetch the opening balance. Okay, so for inventory, we'll go fetch the opening balance. So for cash paid to suppliers and employees is 2 accounts we use: inventory account and the trade payables account. The inventory account is used solely to determine purchases. Okay, so the whole purpose of the inventory account is to determine purchases. So for inventory, my opening balance just make sure I take the right numbers. Okay, inventory is that's the opening balance as an asset. Opening balance on the debit side, it increases. I leave it as positive. For closing balance on the credit side, an asset decrease on the credit side, so I'll make it negative. Now again, I'm going to do the same for trade payables because I'm already on the balance, on the trial balance. So for trade payables, my opening balance, we just see trade payables, trade and other payables. So for trade payables, I'm going to have that. So opening balance increases trade payables, so I have it positive. Closing balance is on the debit side of trade payables, which decreases trade payables, so I'll have it negative. The same thinking that you apply to trade receivables. Remember, this is trade and other payables. You need to have a look. It is a note on trade and other payables. If there's no note, you can take it as is. But if there is a note, you need to adjust the the trade payables account. Remember, you only want trade payables and don't want something relating other than trade payables. So that's very important to take note. In this case, it's clean. So every trade payables relate to purchases. Every trade receivables relates to credit sales. So that's fine. Okay, so now I'm going to complete inventory. So with inventory, we're going to get acquisition of a sub and disposal of a sub. So that's note 4.1 and note 4.2. So under 4.1, there's an acquisition. So I'll go plug it in. Acquisition increases inventory. So I'll leave it as positive. Similarly, over under trade payables, there was an acquisition of a subsidiary. So that increases trade payables. So I'll make it positive. Okay, note 4.3 dealt with the disposal of a sub. So I can go fetch that. Disposal of a subsidiary. So disposal of a subsidiary, it reduces inventory. So it reduces inventory, so I'll make it negative. For disposal of trade payables, where's trade payables? Okay, there we go. The disposal of subsidiary reduces trade payables, so therefore I make it negative as well. Okay. Now I need to go fetch cost of sales. That was under note number 3. Under note number 3, under financial information, we had cost of sales. Cost of sales reduces inventory. Cost of sales reduces inventory. So therefore, I'll make it negative. Cost of sales reduces inventory. So therefore, I'll make it negative. Okay, so our purchases is 17 million. That 17 needs to be positive because we assume all purchases is on credit. So therefore, purchases increases trade payables. So therefore, I'll make it positive. Okay, opening balance increases trade payables. So I'll make it positive. Closing balance reduces trade payables. So I'll make it negative. Acquisition of a sub increases trade payables. So I'll make it positive. Disposal of a sub increases trade payables. So I'll make it positive. And then cash expenses increases trade payables. So therefore, make it positive. So my balance is what I paid for suppliers. I'm going to plug it in so long. It's not 100% correct because we're not yet certain whether we captured everything relating to cash expenses. So once we're done with the question, we'll know whether cash expenses is complete. But for now, I'm going to go plug in this number. Why that is okay? Because what's important, you're going to have an answer in over here. So I'm going to have an answer in under cash paid to suppliers. Okay, so I'm going to have an answer in cash paid to suppliers of that. So while my answer is in over here, so remember cash paid to suppliers is an outflow, so I'll make it negative. While my answer is in over here, I'm going to draw marks. Okay, so that is why I want to go plug it in. I'm not 100% that it's done. So this is working 8. I'm not 100% that it's done because the thing that still needs to be completed is cash expenses. But while I have a number in over here, I'm happy because I will draw part marks. So far, I have cash generated and utilized from operations as 8.6. We're not 100% correct yet. We're not yet sure whether the cash from our expenses, we're not yet sure whether cash expense is done. We still need to go through the entire scenario. Okay, so that is note number 1, note number 2 done. We have covered a large portion of note number 3. Revenue is done. Cost of sales is done. We have touched on other expenses. We have done share of associates profits. So we must all do finance costs. Other income will do loss because that's got to do with dividends. and you must still do income tax. Income tax is a big one. Okay, so we'll do that last as well. This is got to do with equity balances. Equity balance we do last. Okay, so now we come on to note number 4. What I'm going to do over here with note number 4 is quite long. It's already almost 12 o'clock. I'm going to have I have an appointment just now. So I'm going to stop this class over here and you can work through this class so far. I will continue the recording later today or tomorrow, and then I will send a second recording where I complete this question, and I'll start with note number 4. Okay, so you guys okay with that? Do you guys have any question at this point in time? Bernice, Karen, Faid, Rebecca, any question at this point in time? I'm going to stop here for this lesson. I'll upload it today, and then you can work through the previous cash flow and this so far. And what I will do is I will how can I say now? I'll complete the question later on. I start with note number 4 going forward. Okay. Any questions from your guys' side?
No questions.
Okay. Karen?
No questions.
Okay. Rebecca? So what's important to note, just follow the thought process, okay? It seems long because I'm explaining it, but once you have the thought process in your head and you do this under time pressure, you will finish in time and get close to 100%, literally close to 100% for cash flows. Just follow the process. It's making sure you have a thinking process, you're covering all aspects. The nice thing about cash flows, it's showing you whether you kind of know a good portion of your work, because you must be able to reconstruct the T account. You must know for each T account, what increases that T account and what decreases that T account. And then the missing figure will be a cash flow figure that you will plug in. So, okay, so I'll stop there for now. I will work through this later on or tomorrow, and I will upload it for you guys. Okay, but later I'll upload this so you can work through the cash flows and this later on. Remember, test 4's information, the workbook as well as the recordings is uploaded on the Google Drive, so you'll access everything right there together with the paper, the tablet or the past paper. Okay, guys, I'll stop here. Bye bye. Have a good Saturday further and have a great weekend as well.